Chapter 8, Petty Cash and Bank Reconciliation. So what I'm going to talk about here is petty cash. I'm not going to get into bank reconciliation in this video. I'm going to do that on a separate video. So petty cash fund transactions. I want to explain what it is and show you how it's recorded in the company's books. So what is petty cash? So it's in the name petty cash. So whenever you are, for example, petty with somebody or petty to somebody, you are basically concerned with an issue that's very small. So you can be petty with somebody that, hey, you're making an issue bigger than what it really is. So that's what petty means, right? And then cash is cash. So petty is something that's trivial, something that's small, something that's inconsequential. So when you put the words petty cash together and then add fund, of course, it's a fund that's established to make small payments for items like postage or stamps, food, shipping fees, supplies. So whenever you make a payment for these type of items, they're usually small, insignificant in amount. So the purpose of creating a petty cash fund is to avoid writing numerous checks to make numerous small payments for items. So when it comes to writing a check for example, a separate check for postage and stamps, a separate check for food, a separate check for shipping fees, a separate check for supplies, each time that you write the check or each check that's written, it actually costs the company money. Maybe not a lot of money, but it adds up if you are writing a check for each individual item. So petty cash fund process. So there's a process and it's a 3-step process. The first step is to establish the petty cash fund. Then the second step is to withdraw from the petty cash fund. Then the third step is to reimburse the petty cash fund. So first step, you're going to, when it comes to establish the petty cash fund, first you're going to write out a check to establish a petty cash fund. And that's when the company actually has the check in hand and they're making it out to the petty cash fund. So it's paid to the order of petty cash. And that's the company establishing the petty cash fund. And you can say that the check is written for $100. So when you write that check, you essentially are establishing the petty cash fund by writing that check. So cash is cash anyway, so it's coming from the cash account. You just simply take it from the cash account of, for example, $100, and you are transferring it to a petty cash fund for that same amount. The second thing you're going to do is once the check is written, you're going to provide it to the petty cashier or the petty custodian. So that custodian is going to take the check and cash it so they can get the money from that check that was written. And then the third thing they're going to do, which is within the establishing the petty cash fund process or step, is to store the cash, for example, $100, put it in a safe or a place that it's secured because you're going to use that $100 for small items. So here's how you establish the petty cash fund. You're going to debit petty cash. Let me bring my mouse over here if it works. There we go. You're going to debit petty cash fund for $75. That's going to increase the balance in this petty cash account. You're going to credit cash for $75 because it came out of the cash account. Now, again, this is cash. So the petty cash fund here, or this quote unquote account that's being debited for $75, it's not really a actual account because this cash of $75 is coming from the cash account of $75 here, where the $75 is being decreased from the cash account. And all you're doing is you are establishing a petty cash fund to keep track of the amounts that are used for small amounts. Okay, that's what's happening here. So again, debit petty cash for $75, credit cash for that same amount. because this shows you that, or this demonstrates that a check was written for $75 and it was cashed for that amount, and it was cashed to create or establish the petty cash fund. This is why the petty cash fund here is debited for $75 to increase that fund. Now, operating a petty cash fund. So from that $75 that you can just assume that, for example, that $75 is stored in a safe. The petty cash custodian stored that $75 in a safe. This here, what you see here, is what the petty cash is used for. So that cash of $75 is used for this. So on November 1st, you see that the cash was used to buy supplies, and it was for $15. Then you have on November 15th, it was used for food like pizza, wings, and barbecue. So that's my favorite food, which, you know, it goes into miscellaneous expense. That totaled out to be $30. And then you have delivery expense that occurred on November 29th, that the petty cash fund was used to cover this delivery expense of $25. So in total, $70 was spent out of the petty cash fund. So this is just a payment report that shows what the cash was spent on. Okay, this is the second step here, which is withdraw from the petty cash fund. So the first thing you want to do is figure out what's remaining in the petty cash fund. So you take $75, which is what was spent to establish the petty cash fund out of the actual cash account. You're going to subtract out $70, which is what was withdrawn from the petty cash fund to pay for, if we go back up here to the previous slide, these three things up here that came out to be $70, which means that $5 is remaining in the petty cash fund. So to reimburse the petty cash fund, you're going to debit these three items for $15, $30, $25. And you're going to credit cash for $70. So this basically tells you that, hey, out of the $75, cash was spent of $70 for these three items. So this is to reimburse the petty cash fund. Now, if you want to increase the petty cash fund from $75 to $95, you're just going to increase it by $20 by debiting petty cash for $20, credit cash for $20. To decrease the petty cash fund from $75 to $55, you're going to do the opposite. You're going to increase your cash account by debiting cash for $20, excuse me, and then you're going to credit cash for $20 in the petty cash fund account. Now, here's the petty cash fund of $75. The payment report shows $70. What should be remaining in the petty cash fund is $5. That's what should be remaining in the safe. Now, what if $8 is remaining in the petty cash fund instead of $5? So what should you do when there's a discrepancy between what should be remaining and what's actually remaining in the petty cash fund? So $5 is what should be remaining in there, but we have $8. So we have a little bit more that's in the petty cash fund. This is where we are introduced to cash over and short, what to do with it. So cash over and short is an expense account. Okay, so since this is an expense account, this is going to be shown in the company's income statement underneath or under other expense or miscellaneous expense. If there's a shortage, the difference is going to be debited to cash over and short. That's going to increase the expense account. If there's an overage in the petty cash fund, the difference is going to be credited to cash over and short. That's going to decrease the expense account. So given that example here as from the couple of slides before where $8 is remaining, but it should be $5 remaining. So you got to determine what the cash over and short is going to be. So to establish a petty cash fund, we started off with $75. We're going to subtract out the cash that's actually left in the petty cash fund, which is $8. So that leaves us with $67. That is the amount that was spent from the petty cash fund. So this is what was actually spent from the cash fund, which differs from the report that shows us that we spent $70, quote unquote. So the overage is $3. So we need to account for this $3 in the company's books, because this is an overage which is going to reduce the expense account. Okay. So to record the shortage or overage, which in this case, this is an overage, we're going to first debit miscellaneous expense for $70. We're going to credit cash for $67 because that's the actual amount that went out to pay for those three items. And then the difference of $3 is going to be credited to cash over and short, which is going to be a reduction in the expense account of either miscellaneous expense or other expense, because cash over and short, yes, this is its separate name, its own name here. It's going to be rolled into the other expense account or miscellaneous expense account, which are shown in the income statement.